The Child Tax Credit, or CTC, is one of the most significant tax benefits available to families with children, providing a substantial reduction in your federal tax bill for each qualifying child. However, this credit is not available to everyone, and its value is reduced or eliminated for higher-income households. The IRS has established strict income thresholds and phase-out rules that determine exactly how much of the credit you can claim based on your modified adjusted gross income. If you exceed these income limits, you might find that your expected tax savings are significantly lower than anticipated. In this guide, we will break down the eligibility rules for the Child Tax Credit, explain the exact income phase-out thresholds for different filing statuses, and detail the rules regarding the refundable portion of the credit. By the end of this video, you will understand how the Child Tax Credit applies to your household. Let us define the core criteria for the Child Tax Credit. Under current tax guidelines, the CTC is worth up to $2,000 per qualifying child. A qualifying child must meet several IRS requirements. First, the child must be under the age of 17 at the end of the tax year. If your child turns 17 on December 31st, they do not qualify for the $2,000 credit. Second, the child must be your daughter, son, stepchild, foster child, sibling, step-sibling, half-sibling, or a descendant of any of them, such as a grandchild or nephew. Third, the child must have lived with you for more than half of the tax year. Fourth, the child must not have provided more than half of their own financial support during the year. Fifth, the child must be a U.S. citizen, U.S. national, or U.S. resident alien, and they must have a valid Social Security number issued before the due date of your tax return. In addition to these rules, the child must be claimed as a dependent on your return. If the child meets all these qualifications, you can claim the credit, which directly reduces your tax liability. Unlike tax deductions, which reduce your taxable income, tax credits reduce your tax bill dollar for dollar. If you owe $5,000 in federal income tax and have 2 qualifying children, the $4,000 credit reduces your tax bill to $1,000. However, the credit begins to phase out once your income reaches a certain limit, meaning that higher-earning families will receive a smaller credit or no credit at all. Understanding these foundational criteria is essential before looking at the income limits. A child must meet all 7 tests, and a missing or incorrect Social Security number on Form 1040 can lead to an immediate rejection of the credit by the IRS. The phase-out of the Child Tax Credit is determined by your Modified Adjusted Gross Income, or MAGI. For most taxpayers, MAGI is identical to their adjusted gross income, which is found on line 11 of Form 1040. The income thresholds at which the credit begins to decrease are quite high, meaning the majority of families are eligible for the full amount. For married couples filing jointly, the phase-out begins at a MAGI of $400,000. For all other filing statuses, including single filers and heads of household, the phase-out begins at $200,000. Once your MAGI exceeds these thresholds, the credit is reduced by $50 for each $1,000, or fraction thereof, of income above the limit. For example, if you file as a single parent with 1 qualifying child and your MAGI is $205,000, your income exceeds the limit by $5,000. Because the credit is reduced by $50 for each $1,000 over the limit, your credit is reduced by $250. Therefore, instead of receiving the full $2,000 credit, you would be eligible for $1,750. If your income is high enough, the credit is phased out completely. For a single filer with 1 qualifying child, the credit becomes zero once income reaches $240,000. For a married couple with 1 child, the limit is $440,000. If you have multiple qualifying children, the income limit at which the credit disappears is higher. Each additional child adds $40,000 to the phase-out ceiling, as the reduction calculation is applied to the total combined credit value rather than to each child's credit individually. Another critical aspect of the Child Tax Credit is its refundability. The CTC is a partially refundable credit. The refundable portion of the credit is called the Additional Child Tax Credit, or ACTC, and is claimed on Schedule 8812. The ACTC is worth up to $1,700 per child. If the credit reduces your tax liability to zero, you can receive up to that limit back as a refund. To calculate the refundable portion, the IRS uses a formula based on your earned income. The refund is limited to 15% of your earned income that exceeds $2,500. For example, if you earn $20,000, 15% of the amount above $2,500 is $2,625. If you have 2 children, this formula allows you to claim the full refundable portion, subject to the per-child limit. If you have no earned income or earn less than $2,500, you cannot claim the refundable portion. Additionally, if you have a dependent who does not qualify for the CTC, such as a child aged 17 or older, or an elderly relative, you may claim the credit for other dependents, which is a non-refundable credit worth up to $500. In summary, the child tax credit is a powerful benefit for families, but you must track MAGI thresholds and understand the earned income formula to determine your actual savings. By monitoring these limits, you can manage your tax planning. To ensure a smooth filing process, keep copies of your children's birth certificates and social security cards, and verify that their names match exactly on your return. If you share custody of a child, remember that only one parent can claim the child as a dependent and receive the credit in a given year. The custodial parent typically claims the credit unless they sign Form 8332 to release the claim to the non-custodial parent. Reviewing these custody agreements early prevents conflicting claims that can delay your refund. Taking these structured steps protects your family's benefits. Tax Season School explains tax rules, tax documents, and simple filing habits in plain English. The channel covers W-2 basics, freelance filing, deductions, HSA rules, and common mistakes so viewers can stay organized and make informed decisions with their money. This video is general financial education, not professional tax, accounting, legal, or investment advice. Tax rules change frequently and vary by location and situation. Consult a certified public accountant or tax professional before making tax decisions.